Hello, Internet friend. Today on Value Side, reading the financial markets, the second quarter of 2025. I'm David Ravel. Well, relatively few investors are day traders, yet most of the technical market indicators are computed daily. This leads to a very myopic perspective. It's like driving a car with a microscope. You'll eventually see the oncoming traffic, but it may be after you crash. Today we'll look at the second quarter, and what a remarkable 90 days it was. The most significant event of the quarter was undoubtedly Liberation Day, April 2nd, the day that President Donald Trump presented the world with his outline of worldwide tariffs. Now, many pundits pointed to this event as the beginning of the investors' woes and the financial market declines. However, most stocks were already in a downtrend, with groups such as healthcare, basic materials, real estate, energy, and technology already moving lower. Only utilities and consumer defensive stocks, those are mainly retail stores and products, could eke out a gain in that second quarter this year. So while important, the performance in equity markets suggests that the tariffs accelerated an already existing trend. Here's a look at specific financial sectors. First, the U.S. dollar. It's the global reserve currency, of course, and as such is a vital and essential part of the international trade and finance. However, this quarter's cross-currents have presented the dollar with significant headwinds. The U.S. willingness to use the dollar as a geopolitical instrument through tariffs, international banking, read SWIFT, and boycotts has led to a decline in the dollar's relative strength against other currencies. In Q2 2025, the U.S. dollar index fell by 9%. Energy. Oil is the most readily available proxy for the nation's energy use and a good representation of future economic activity. Rising oil prices, which often accompany rising demand for energy, generally indicate a positive economic growth, while declining oil prices may predict a decline in economic growth. West Texas Intermediate, the country's most watched oil price, declined by 2.4% in that last quarter. Monetary metals. Historically, gold and silver have been principal methods for investors to hedge against a decline in the country's currency. In this latest quarter, gold was virtually alone as the only financial asset, except for a select number of equities, to show a positive return. Silver, on the other hand, was flat. Gold rose by 13% in the second quarter. Cryptos. Another currency alternative is the emerging cryptocurrency asset class. Bitcoin, the most widely followed cryptocurrency, remained essentially unchanged during the past quarter. Bitcoin was flat. Copper. On Wall Street, copper has been given the special moniker of Dr. Copper due to its seeming ability to predict future economic activity, especially for real estate, where copper is a principal component. Copper has also been useful in predicting the onset of inflation. In Q2, copper gained 11%. Bonds. U.S. Treasuries have gained special significance during this time of high federal government deficits. Bonds, after all, are the chief source of funding for the central government. Bonds are also sensitive to any change in interest rates. While the Federal Reserve directly impacts short-term interest rates, the market sets longer duration yields. This quarter saw little price movement in bonds, with the 30-year bond trading flat and the shorter 2- and 10-year bonds rose, but just slightly. So Q2 bonds, 30-year flat, 2- and 10-year bonds rose 2%. Equity indexes. Q2 saw declines in all the major equity indexes with some surprises. The Dow Jones Industrial Average declined by 8% in the quarter, while the Standard & Poor's Index fell by 6%. However, here's the surprise. The NASDAQ 100 also decreased by only 6%, far less than anticipated. As a group, The most widely affected was the broad-based Russell 2000, down 10%. In Q2, equity indexes all declined, but are not yet in a bear territory. Stock market leadership. Well, we see the most worrying price action in the leadership stocks. For many months, the Mag 7 have captivated investors' attention with their seeming ability to weather any financial storm. However, recently the Mag 7 resilience has come into question. Using a commonly utilized rule of thumb, if a 20% reduction in price indicates a bear market correction, then 5 of the Mag 7 are experiencing bear market declines. Going back 2 quarters to Q4 of 2024, only Microsoft and Apple, which do have lower prices, are not yet in a bear market. The other 5 stocks, NVIDIA, Amazon, Google Alphabet, and Meta Facebook, have all declined by 20% or more. Technically, this decline in the price action of these market leaders is a concern for all of us. Conclusion. I recently watched an interview with David Solomon, president of Goldman Sachs, and it was amusing to see how many times Mr. Solomon could incorporate the word uncertainty into his answers. Although one would hope that he could come up with a synonym, he correctly assesses this as one of the most uncertain periods for financial markets and investors. While we saw some particularly volatile moments associated with President's tariffs announcement, especially in the U.S. bonds, overall the financial markets have regained their composure and seem headed on a steady course, if unfortunately at the moment that course portends a slight decline in economic activity and hence financial market performance. Now, if you enjoyed this article, please consider buying me a cup of coffee. Go to buymeacoffee.com/David Revell. That's REAVILL. Buymeacoffee.com/David Revell. Thanks for listening.